Meta stock has been hit hard recently, dropping more than 16% in just a few weeks. Today we're breaking down exactly why the stock is falling, what's causing investor fear, and whether this pullback is actually a buying opportunity. Let's start with what shocked the market. A news report suggested that Meta may have earned between $12 and $14 billion from fraudulent ads over the years. These are scam ads that trick users, and Meta still earns revenue from the impressions. The allegation isn't that Meta created the scams, but that the platform profits while users get hurt, and that's triggered something much bigger. Regulators in the European Union are now considering what could be a record fine of $1 billion. For a company the size of Meta, a fine like that is not going to destroy the business, but it could open the door to tougher global regulations, more legal costs, and a major hit to reputation. Investors hate uncertainty, especially legal uncertainty. That can cost a lot, and that alone is enough to push a stock a lot lower. But that's only part of the story. At the same time all of this is happening, the largest tech companies, including Meta, have been issuing massive amounts of debt. In just the last 3 months, Google, Amazon, Meta, Microsoft, and Oracle issued $88 billion of new debt. For context, that's more than the previous 3 years combined. And November alone saw nearly $40 billion in new bonds. Why does that matter? Because companies only raise this much debt for one of three reasons. They're either betting big on future investments, they're preparing for something expensive, or 3, they need liquidity because conditions are tightening. In Meta's case, it likely means 2 things. They're still aggressively investing in AI and infrastructure, and they're preparing for an environment where cash may be king. But when you combine heavy debt issuance with big regulatory risks, markets can get nervous very fast. Okay, let's do a bit of fundamental analysis. When we look at Meta's fundamentals right now, the picture is broadly solid, but not without some important considerations. Meta sits at around a $1.6 trillion market cap and generates roughly $190 billion in annual revenue, making it one of the largest advertising businesses on the planet. Profit margins remain healthy, gross margins are nearly 82%, operating margins are around 42%, and free cash flow margins come in at roughly 24%. Those levels of profitability show that Meta's core ad platforms are still highly efficient, even with continued heavy spending on infrastructure and AI. Capital efficiency is another area where Meta continues to perform well. Return on equity and return on invested capital are both close to 29%, meaning the company has historically been strong at converting reinvestments into earnings growth. That's an encouraging sign, particularly as they scale new AI-driven features across Facebook, across Instagram, and across their ad network. On valuation, the stock sits in a middle ground, not cheap and not excessively priced relative to growth either. So the trailing price to earnings ratio is around 29, while the forward PE drops closer to 22. Earnings growth is still expected to remain solid, with projections calling for roughly 19% forward revenue growth and low to mid-teens long-term EPS growth. That suggests investors are paying a reasonable premium for ongoing expansion rather than purely speculative expectations. That said, free cash flow valuation remains elevated with a price to free cash flow multiple in the mid-30s. This reflects the reality of Meta's heavy investment cycle, substantial spending on AI infrastructure, compute capacity, and new product development continues to weigh in on near-term cash flow. Whether those investments generate long-term returns, we don't know that yet. It remains a key question for investors. Financially, Meta maintains a strong position. The company holds about $44 billion in cash, carries relative to modest net debt, and has excellent interest coverage. Liquidity risk is low, and their balance sheet provides plenty of flexibility to continue investing while also returning to capital to shareholders. The introduction of a dividend is now yielding around 0.3%. It isn't aimed at income investors, but does signal sustained confidence in cash generation. You only issue a dividend if you are sure you can continue to issue it normally. Overall, Meta's fundamentals appear stable with ongoing growth potential, but the valuation assumes continued execution, especially around AI monetization, making future results important to justify the current price. From a price standpoint, the stock has been uneven recently. Over the past 3 months, Meta experienced a drawdown of more than 12%, even as the underlying business performance remains steady. The shares have since recovered towards the mid $600 range, suggesting buyers are re-engaging after the pullback. This type of divergence, where company fundamentals stay relatively stable while the stock remains volatile, is common during periods of market uncertainty. It often reflects shifting sentiment more than meaningful changes in the business itself, and it's something long-term investors tend to watch closely. So the real question is this crash justified? On the negative side, regulatory risk is very real. If the EU fine becomes a template for future penalties in other countries, Meta could be facing billions of dollars in potential legal exposure. And if fraudulent ads get more attention, regulators may force Meta to spend far more on content moderation and safety, and that's going to cut into profits. On the positive side, Meta is still dominant in social media, it's still an ad powerhouse, and its investments in AI could unlock even more revenue. And historically, whenever Meta sells off because of regulatory fear, such as Cambridge Analytica or Apple privacy changes, antitrust headlines, it has almost always recovered, often recovered aggressively. So should we buy? Well, that's always up to you, but this pullback, it could be an opportunity if you believe Meta's long-term strength outweighs short-term regulatory noise, the fundamentals haven't collapsed, the business is still printing cash, and if the fine ends up being smaller than expected, the market could snap back quickly. But if you're worried that this investigation is just the beginning of a much bigger global crackdown on Meta's ad model, then the stock may be risky at these levels.